This is one of my favorite things. How can you profit in a market downturn? Are you feeling anxious about the markets right now? Because they are going down and they're going to continue to go lower. But don't let that bring you down, because in this video, what I want to do is I want to show you how you can profit during really tough economic times like we're in, or definitely like we're going to be in. You're going to learn practical strategies and tactics on how to protect your portfolio. So stay tuned and discover how you can turn a market downturn into a financial opportunity of giant proportions. So the first thing I want to cover is how a market downturn can prevent an awesome buying opportunity for long term. Now, most of you already know this, right? When things go down, it creates a good buying opportunity. It's like when you walk into your favorite department store or Walmart, right? It's a rollback. You want to buy things when they're on sale. The first things they put out front are the sale racks. So, or maybe they're in the back of the store, so they get you through all the expensive stuff to buy. But that's where you go. You want a deal. Warren Buffett said it best. There's three things you need to do to make money in the markets. Number one, you got to buy low. Well, a market downturn provides that opportunity to buy low. And you already are starting to see that happen. You're seeing real estate in some states start to pull back. Most all states are pulling back a little, but some more than others. And you're going to see that continue to go, which presents a huge buying opportunity, but right now might be a bit early. You're seeing stocks, especially tech stocks, selling off right now, whether it's Netflix or Apple or Google or Amazon, any of the old FANG stocks, you're starting to see them come off of their highs, and some of them come severely off their highs, but they got a lot further to go. So these are all opportunities in the making. The question is, does fear prevent you from buying these stocks? Because when everything's selling off, when the markets are falling apart, when a market downturn kicks in, everybody gets scared and they pull back and they don't want to start buying. I mean, just like this, there's different market cycles. We're in the fear cycle right now, okay? Which means other people, when they're fearful, means you should be greedy. So that means you should be looking for buying opportunities. You shouldn't get scared, but you have to be prepared. So that's a key part. You have to understand that market downturns are going to present these opportunities only to investors that are prepared and ready for them. The second thing that you really should be looking into is diversification of your portfolio. Diversification is the almighty, but you know what? A lot of people don't understand diversification. They think when I say diversification, they think, oh, I've got large caps, small caps, mid caps, I got a couple internationals, and I got this other bond fund in there. Yeah, that might be brushing the surface, but I'm talking about diversifying amongst asset classes. Maybe you got some real estate investments. Maybe you got some treasury bonds. Maybe you got some private loans. Maybe you're in a private hedge fund. Things that are non-correlated to the markets. And what do I mean by non-correlated? When the stock market goes down, nothing happens to a non-correlated asset class. Let me give you an example here really quick. You see this? This is called the inverted yield curve. This is something we witnessed in 2022 and something we're going to continue to see in 2023. This is the number one indicator for a market downturn. Because I know some of you are looking at this saying, I don't know if the markets are really going to sell off. Of course they are. The inverted yield curve since the world wars has never been wrong. When it inverts, we always enter a recession, which means this time we're going to be in a recession. Absolutely. But you need to understand the difference between diversifying stocks, mutual funds, ETFs from diversifying asset classes. So when we really look here, here's your stocks, mutual funds, ETFs. You also have bonds, you have cash, you have commodities like oil, you have real estate, private equity, like private investments into companies. You have investment business in your business or different business opportunities, alternative investments like BYOB, those specially designed and engineered whole life insurance policies. Those are definitely no risk because they're guaranteed by an insurance company, and private funds. So when we look at all of these different things, we really have to understand what is it that you're going to do to diversify your investments. Now, I don't care if your investments are 401ks, solo Ks, 403bs. There's a lot of cool things we can do to diversify within that, but you need to think bigger, and you really need to understand what I just went over with the asset classes. So number three, let's talk about evaluation of the financial health and stability of potential investments. So how do you evaluate the different investments you're going to look at? Do you always know, like, and understand the investments you put money into? Because most people don't. Most people just jump in based on an emotional-based decision. And that's not evaluating anything, except for maybe you should get evaluated yourself. Because making emotionally driven investment decisions really is not good for your financial health and is not good for your regular health because it never ends well. But you see, if you evaluate how a company operates, if you evaluate and get to know the investments you're putting money into, like I'll give you an example in a second when it comes to treasury bonds. How many of you right now, before I explain this, can tell me how you can evaluate a treasury bond? It's simple, right? It's one of the simplest investments. It's an IOU from the U.S. government. They give you an IOU that they're going to pay you back in a certain amount of time, 10, 30 years, whatever bond you buy, and they pay you an interest rate. You're probably thinking, well, what more do I need to know? A lot. Because when you understand the financial stability and the potential of the investments that you're going to put money into, you can really understand how to weather a downturn. Now, if it's stocks, Apple, Google, any of those stocks, I'm not making a recommendation, but you can look at their fundamentals. You can look at their balance sheet. You can look at their financials. But some of you are like, I don't have time for that. I don't know anything about that. Okay, well, let's come back to treasury bonds. Real quick, I just want to show you how I look at these. You see, most financial advisors will understand this, but they won't tell you about this because there's no money in it for them. So a treasury bond is an IOU from the U.S. government. And treasury bonds come in different durations. You can do 2-year, 10-year, 30-year. I'm not going to go through them all, but you can buy all sorts of different durations. And each duration pays you a different interest rate. Now, these rates are wrong because they're a little bit old, but here's what I want you to understand. When you buy a bond from the U.S. government, they're going to pay you an interest rate. In this example, I wrote down 4.05%. Whether that's the interest rate or not, it doesn't matter. That's how much you're going to get paid for buying this bond. But here's the thing. To understand and evaluate this bond would take a little bit deeper look. So I know for a fact that the price of bonds goes down when interest rates go up. So right now, where are interest rates going? Are they going up or are they going down? Right. We're in 2023. This is January. Interest rates are going up. The Fed has vowed to destroy inflation and bring it down to their target of about 2%. I think right now we're somewhere in the mid-6s. So to get from the mid-6s down to 2 requires the Fed to keep raising interest rates. So I know interest rates are going up, which means I know for a fact the price of bonds is going down. That creates a really good buying opportunity, right? Well, some of you might be saying, well, I don't know. If the price is going down, shouldn't we buy? Remember Warren Buffett, buy low? Yeah. But you see, we need to understand Warren's other two, because the second part of buy low is to make money, you have to sell high. So here's how that happens, and this is the fourth thing. You have to understand that to make money and get ready for this market so you can buy, you're going to have to sell off some underperforming or high-risk investments so that you don't lose more money. You have to decide where's your jumping off point. Most of you wish you would have got out a couple months ago, but some of you didn't. You held on, and now might be your last stop before the thing really drops. So you got to get rid of some underperformers and some high-risk investments that don't fit your asset allocation mix. Now, reallocating these funds into stronger fundamental stocks or maybe treasury bonds might be a good strategy, but you got to buy low and sell high so that you don't lose money. So let's come back to treasury bonds, right? We already know how we can buy low because we just got to watch interest rates. If interest rates go up, we get to buy low. So buying these treasury bonds might not be a bad thing to buy if you're looking to buy low. But then we got to sell high. So what will happen next is eventually when the Fed stops raising interest rates, they will then probably move to start lowering interest rates because we'll be in a recession. Okay, we'll be in that buying opportunity I mentioned, and we're going to need to then kind of come out of that. So the Fed has a tool, and that's a lever. Push it up for interest rates going up, pull it down for interest rates going down. It's literally that simple. So they're going to drop interest rates. Now, when interest rates start going down, the price of those bonds will start going up. And when the price of the bonds go up, we are going to sell them. Buy low, sell high, and get paid the whole time, because the government will pay you an interest rate, a yield on your money. You see, now you've learned something. You've learned a fundamental strategy on how you could use treasury bonds to get ready for this next market downturn. And it can be very beneficial for you to have a mix of both defensive, right here, and growth-oriented investments in your portfolio to balance out the risk. So you might be playing this, treasury bonds, for the defensive side, because we know when interest rates go up, the markets typically are going to go down. This is defensive, okay? And then when the interest rates are going down, when the market's already deflated, we know the price is going to go up. But we also might want to look at some growth-oriented investments, some things that are going to provide future growth, maybe buying real estate when it goes down, maybe investing in one of those tech stocks, the real strong one that you know, like, and understand, so that when the markets rebound and come back up in a year, 2 years, 3 years, whenever that is, you now have your portfolio balanced. Now, there's way more to this, but I just wanted to give you a couple little tricks on how you can play this game. Let me give you one more. This is like a bonus round. So here's a little bonus round. This is where the markets were last year and what we've done. We've wrote a straight line right up, okay? From the down in the pandemic right over here, we'll just do that, up to here, that was your high point, which we've been telling you to get out ever since, okay? We're probably about here, about a 20% drop in the market, maybe plus or minus, depending on what you're invested in. So we know, or we can articulate, that this is where the markets are going to go down to. So here's a really good strategy with that buy low, sell high. Let's just say you got an investment or a 401k, and you're looking, how do I do this? Set up a dollar cost averaging every week, every pay period, whatever it is. What you should be doing is you should be buying into this market. I don't care what price you buy, just start buying into it systematically. Okay, this is called dollar cost averaging. So if you systematically just start buying, you are beginning the process of buying low. So that's what you want. But then when the market turns around and we're back over here and we're coming up, we got to pick a point to sell high. This is where most people fail. They forget to sell high because they're always waiting for the high point and they never seem to get it because your emotions and because of greed, you always lose. And then down here you think, oh, I don't want to sell because it's too low. Wrong. You definitely should. So this is where people forget to take action. They all know the buy low, right? This is the easy part, but they always forget to sell because of greed. They're always hunting and waiting for the high point. I'm going to sell when it gets to the highest point, but they never seem to get it, just like now. You missed it. We're now 20%, but for most people, this is still your highest point you're going to be at. So that's what you got to realize. There's never going to be a perfect time. You're never going to get the top and you're never going to get the bottom. You can't time the market. So the best way to do it is to dollar cost average in and then plan your exit somewhere at some percentage of return. Maybe it's plus 20, maybe it's plus 30, maybe you're greedy and you say, when I make 100%, I'm out. Great. Write it down and get out. So let's just go back and do a quick recap. This whole video is all about how a market downturn can present huge buying opportunities for long-term investors. And that started with diversification of your portfolio and how you can mitigate risk out of the market fluctuations by being invested in assets, different asset classes, some that are non-correlated, meaning they're not tied to what the stock market does. Then the third thing we talked about was evaluation of the financial health and the stability of potential investments. Looking at fundamentals. Remember, we did the treasury bonds. So how can you weather this downturn? Well, you can weather it by identifying the ones that are most likely to do well during a downturn. And we talked about selling off underperforming or high-risk investments that don't fit your risk tolerance and then reallocating those funds to a stronger place, a place where your money could be diversified smarter, like a smart strategy like those treasury bonds I just mentioned. Buy low, sell high, and don't lose money. And the final thing I mentioned was how it can be beneficial to have a mix of both defensive and growth-oriented investments in your portfolio to balance out the risk. Folks, if you like this video, you're going to love this one right here. What is the best way to protect your wealth? Check it out. Thanks for joining me. We'll see you on the next one.